Good morning, everyone, and welcome to today's webinar, Bond Issuance for Banks, which is hosted by both Theiss and organized in cooperation with Vienna Stock Exchange. My name is Katerina Kraeva. I'm partner at both Theiss, based in Sofia, specializing in banking and finance. And I will open today's webinar with some introductory notes to set up the context of the topics that we will discuss later on. In today's session, I will be joined by my partner, Alexander Haas, who will lead us through the transaction process, documentation, and the role of the participants from European perspective. As we will elaborate in the course of the presentation, most of the aspects of the bond transactions are governed by European-wide regulation. Therefore, when we work on bonds projects, we build up on the expertise of Alex and his team, and as in the most of the cases, it is directly applicable in projects in Bulgaria. We'll after that touch upon the Bulgarian aspects of the issuances, which will be covered by my colleague Irina Dekova. Since after listening to 3 hours in a row, you may start being slightly distracted by the level of the technical and legalistic details, not to blame the nice weather outside, we have kept for the end of the session the vivid presentation of Matthias from Vienna Stock Exchange. He will share the commercial and financial view of a venue with a growing positioning on the debt capital markets arena, which at the same time is close to Bulgaria due to many commercial and financial links, and it is a natural choice, easily accessible for attracting broader range of investors. We have prepared today's event as rather introductory, type more of the nature of helicopter view on the topic, as we tried to test in advance what would be relevant for the audience. So if some of the aspects that we will cover today might be of particular interest for you, we will be happy to host a follow-up event and dig further on more specific questions which you may consider relevant for your practice. Just a little housekeeping before we get started. We aim the overall duration of the webinar to be less than 2 hours, hour and a half. If you have any questions during the presentation, please type them in the chat box in your WebEx control panel. We may either bring them up during the presentation, or if this will interrupt the space of the speaker, we will leave some time for answering the questions at the end. So I will encourage you during each of the presentations to raise questions, and we'll be glad to answer them. This webinar will be recorded, and the video will be distributed to the participants today. Aiming to be as interactive as possible with view of the circumstances, before we begin, I would like everyone to answer the following poll question. Are you considering the possibility to issue bonds? And there will be also 2 other questions that we will be interested to hear your plans during the presentation. The intention is just to test the actual interest for bond transactions, and we will summarize the responses at the end. As some of you may know, before the pandemic, we were regularly hosting in our office here in Sofia a series of seminars which were called Coffee and Law. Today's event is the first after the breakup of this series. It is in digital version, but still, I think that this cannot prevent us of having a coffee together, although virtually. So now, without further ado, please grab your cup of coffee as I'll continue with the introductory notes. Why we are addressing the banks with this webinar, why we decided that this might be of interest. First, banks can act as issuers in different kinds of banks participate in this capacity, including local banks and supranational banks. Second, banks may act as dealers. The role of the dealer is to help the issuer sell bonds on the market. Very often, a dealer would underwrite a bond issue. That means that the dealer will acquire the whole issue either alone or on a syndicate with other dealers. Then they need to on-sell the bonds to the market, and this will represent a regulated investment activity for which a license in Bulgaria as well is required. So this role may only be undertaken by banks or investment firms. Dealers will usually be involved in the process and will assist in putting together the legal documentation. Finally, banks may act as investors. Indeed, bonds are often considered to be a core part of well-diversified investment portfolio. Alex will touch upon after that in further details on the roles of the participants in the bond transactions, but this is just to give the skeleton and the context of what we will walk you through during the session today. Why we are focusing on the bonds and why we are thinking that currently is the right moment to do this. From our practice, we see increasing number of projects where Bulgarian corporates and banks are acting as issuers and investors, while previously the local entities were mainly having supportive role as guarantors or security providers in cross-border bond issuances. In most of the projects that we are working, there is a foreign cross-border element, so there with a certain level of complexity, and we thought that it might be the right time when there are also few projects ongoing currently to share our experience with this project so far. So now let's discuss why use bonds and not, for example, loans at debt financing and the main differences with loans. I will just highlight a few of the differences between them, and we'll be glad to hear more about this from Matthias from Vienna Stock Exchange from business perspective. So first, probably the obvious difference is the capacity of the debtor in the structure. In a capital markets issue, a borrower traditionally issues a document evidencing the debt obligation in return for money it receives from the lenders. The borrower, therefore, is known as the issuer rather than the borrower, while in the vast majority of loan facilities, at least initially, the grantors of the financing are banks. For bonds, a wide variety of institutions may act, also individuals. The lenders are known as investors and represent a broader base than traditional lending banks. Investors in this sense may also and more often include insurance company, pension funds, asset managers, and since the potential number of investors is far greater than lenders offering loans, the amount of funds available to an issuer is potentially much larger and interest rates rather lower. This wide investor base allows a borrower's debt and any risk to be spread among numerous investors. As a next feature, the bonds will often lead to advertising effect, which may offer an additional attraction. Next, in a bond issue, usually no collateral will be required for investment-grade issuers, which makes this form of debt financing even more attractive. Bonds are easily tradable between the banks or on a secondary market, and even now with the advent of LMA agreements, most loans have a limited market. In contrast, the capital markets are well established and geared towards the relatively quick and simple trading of debt. The ability to sell bonds easily and quickly provides liquidity to the market, and this means that investors are prepared to accept lower yields, which reduces the cost of borrowing for the issuer. The more extensive market means that the size and maturities of the debt can be more varied than for most commercial loans. certain debt securities can be with significantly lower term than commercial loans. For example, the 30-year matured securities quite often are the government bonds. Generally speaking, as probably the next point, the undertakings and events of default in the terms and conditions on the capital market securities are less onerous and restrictive than in a facility agreement. There is no specific relationship bank which will monitor compliance with wide-ranging financial covenants as there would be in a loan facility, although a trustee may have a role of overseeing standard undertaking. In Bulgaria, a bond trustee may have such a role in case of secured bonds. In addition, there are certain tax incentives for investors in bonds, which we'll discuss in more detail later on. Of course, just like with everything, there are certain downsides to issuing bonds. It is difficult to renegotiate terms as concept of the bondholders is required for changing to the terms. This makes the process a bit burdensome and slow. Bonds are more often used by larger entities due to the complexity of the process and the cost which may sometimes be involved. These costs may be high even for small issues. Next, listed bond issue will inevitably involve publicity, which may signal to the market that the issuer is in need of funds. In certain cases, when a prospectus will be required, such prospectus will need to be approved by the competent authority, which may lead to negotiations with this authority communication. In case of listing in particular, ongoing reporting and compliance obligations will apply. As a whole, the process could be slower, more expensive, and with more parties involved, including in some cases the regulator. We will move further with general overview of the legal framework. Being lawyers, we could not avoid mentioning this. We have highlighted on this slide just a few of the main acts to give you perspective that the framework represents a combination of local and European acts. Depending on the projects, and as some of you may have already experienced, the European regulation might be of significant importance as it is directly applicable, what is the case mainly of issuance of capital instruments for regulatory purposes, what is specifically additional tier 1 notes, which is something already seen on the market as practice. The local framework is not simplified either and has undergone material changes recently. Each lawyer practicing in Bulgaria is probably used to the changes in the Public Offering of Securities Act, where more and more provisions are simply disappearing, being replaced by European regulation. So this is a sphere that you need to follow and practice in order to have even general perspective on the process. Recently, for a project, we were willing to check what is the time period for a regulator to respond on the application for a prospectus, which was previously clearly set out in the local legislation. Now this is something which is governed by the prospectus regulation, so you need to check few acts to find a simple answer like this. The local legislation is still in process of development. The last piece in the puzzle is the draft law on the covered bonds, which will expand this type of instruments previously limited to the mortgage-backed bonds. I have outlined at the beginning the main roles of the banks in the process, and as I mentioned, we will hear more about this from Alex, specifically on the issuance steps and participation in the process of the issuers. From my side and from Bulgarian perspective, I would like to highlight just a few aspects on the capacity of banks acting as dealers and also as investors. Now let's take a look at the banks as dealers. As such, they very often focus on their relationship with individual investors. For example, offering of bonds to individuals, high net worth private investors becomes more often recently. Such offering, however, shall be subject to prior assessment if the individuals, private investors, may be deemed acting as consumers with respect to the purchase of the bonds. In the latter case, additional rules and protections in favor of the individuals might be triggered under the Bulgarian consumer protection rules. The first question to consider is when an individual investor shall be perceived as a consumer. It may be assumed that the high net worth individuals willing to invest large amounts into securities might be presumed to have sufficient knowledge of the securities industry, and this might be an argument why they should not be treated as consumers. However, existing practice of the Bulgarian Consumer Protection Commission favors a narrower interpretation of the definition of consumer, and it perceives that the amount of the investment and the fortune of the individuals are not decisive but supportive criterion for the qualification as consumers. The main criterion is whether the individual acts outside of his business profession or not. The second requirement that need to be considered is where there need to be a provision of financial services. Usually the provision of financial services takes place at the level of the dealer, investment advisory, which when conducting certain private investors might be found as offering financial investment services to them rather than at the level of the bank when issuing the banks. As a third step, it will be also relevant if the individual investors will be approached in a distant manner. And here the regime for distant marketing applies, which provides higher requirements for information disclosure, contractual safeguards for consumer, which is a little bit more flexible as the Consumer Protection Act excludes financial services from most of the information and language requirements. Depending on the case and exact qualification of the capacity of the high net worth individual, for instance, the private investor, different safeguards may apply to investor as consumer. The most typical one are specific and more enhanced pre-contractual and contractual information. Usually it may be already covered in the prospectus, but deviations to the required scope and details are also possible. Language requirement. When the financial services applied to consumers on the territory of the Republic of Bulgaria, any initial information shall be provided in Bulgarian language or translated in Bulgarian language as well. For example, the prospectus regulation may not require that information and risk assessment are done in local language, but the consumer protection rules will prevail here and require parts of them to be translated and summarized into local language. Finally, consumers are also entitled to file complaints to the local payment dispute conciliation committee with the Consumer Protection Commission and the Financial Supervision Commission. I wanted to focus on this one because when you are considering a financial product, probably the focus on the consumer protection is something which is less common for the banking industry, specifically in corporate loans. And when we are discussing alternative investments between loans and bonds, this is also one of the specifics that need to be considered. Another focus point from Bulgarian perspective that I would like to highlight now at the beginning are the tax incentives for investing in certain type of bond issuances. These incentives are related to listed bonds. In this case, the interest payable by a Bulgarian bond issuer would be exempt from the 10% Bulgarian withholding tax. This exemption will apply where the bondholder is a non-resident entity, in two cases. The first is when the bonds are listed on a regulated market, either in Bulgaria, European member state, or European Economic Area country. And the second is where the bonds are listed on a SME growth market, again in Bulgaria or the equivalent European member states. The key point here is that the exemption will be applicable to the extent the bonds are listed on regulated market. So exchange regulated markets as the MTFs, which allow greater flexibility in terms of the issuance, and the process there is much more simplified due to the absence of prospectus requirement. The MTFs will not serve the purpose of providing this tax exemption for investors in the bonds, but at the same time is an incentive for primarily for foreign banks as giving advantage over the extension of the law of a loan where this tax incentive is not applicable. We have provided here the link to the website of ESMA where the regulated markets are listed. So you may easily check at this list which venue is considered a regulated market for the purposes of the relevant definition, and also applying this incentive. So now let's quickly take a look at the main type of bonds. First, bonds may be materialized or dematerialized. Material bonds are paper documents, while the dematerialized bonds are registered in a depository institution. Bonds may be registered in Bulgarian Central Depository, but also in a depository in another country, including when the issuer is a Bulgarian entity. The bonds further may be ordinary, this which only give the bondholder the right to receive the nominal amount of the bond together with interest, and preferred, which are such that give additional rights. Convertible bonds are an example of preferred bonds. They give the bondholder the right to convert his bond into shares in certain cases. It is also possible for the bonds to be secured with different types of security. One example, as I mentioned, is the mortgage secured bonds, which are regulated in Bulgaria under the Mortgage Secured Bond Act. Finally, the bonds may be publicly offered or privately placed. In case bonds are registered in a non-Bulgarian depository, it may still be possible for those bonds to be admitted to trading in Bulgaria, depending on the initial depository and certain technical requirements from the Bulgarian Central Depository, which is the clearing and settlement agent for transactions on the Bulgarian Stock Exchange. Furthermore, the Bulgarian Stock Exchange has been developing a special market for international capital instruments for the past several years, which is called Bulgarian Stock Exchange International. Once that market is opened, then it would be easier for capital instruments listed abroad to also be listed on the Bulgarian Stock Exchange and trade in practice. Currently, probably the share segment might be the first to be tested. So we will follow the developments on this one. So this was the end of my presentation. As mentioned at the beginning, we will encourage the audience to raise some questions. And now I will, before giving the floor to my colleague Alex, will set the second question, poll question to the audience. And again, please, you may use the polling application to ask it. And the second question is similar to the first one. And while in the first case we were looking at your potential plans as issuers, the second question is more focused on the role of the banks as investors. So the second poll question that we would like to check the opinion from the audience is, are you considering the possibility to invest in bonds? So with that one, I'll give the floor to my colleagues, Alexander Haas, partner, debt capital markets in Theiss, Vienna.
Thank you very much, Katerina. Hello, everyone. Good morning. Nevena Skocic and I will lead you for the next part of this presentation. We are from the DCM team in Vienna, supporting debt capital markets transactions throughout the regions. I myself have 15 years of experience in this field, and since a few years, Nevena joined our team in Vienna. There I posted a statement from Andrew William Melon. In case someone doesn't know this gentleman, that's the founder of the Bank of New York Mellon, who said, "Gentlemen prefer bonds." Why is this statement here given? Why would gentlemen prefer bonds? Well, bonds are considered, compared to other securities like shares, the more conservative investment instruments, which offer a higher level of security for the investors, which is what we have seen recently. I think the reason why more and more investors considering investing in bonds, given the interest environment. Even many investors are considering investing in bonds of sub-investment grade issuers. Just to navigate where we are in the following metrics, you see the different types of securities, starting with ordinary shares down to senior bonds. We will only cover aspects of senior bonds, which might also apply to subordinated bonds. So when we speak now about the transaction types and about documentation, please bear in mind that this holds generally only true for normal, so to say, plain vanilla bonds of investment grade issuers. In case of other instruments or other issuers, different requirements may apply. So first we will speak about the documentation in a typical DCM transaction. What will you have? You will have a kind of due diligence, which is different than in an ECM transaction. So usually a due diligence in a DCM transaction is done by the managing board of the issuer answering certain questions. The issuer will be responsible for the business description in the prospectus or other offer document. The managers of the issue, so the banks which underwrite, they might be sued on the basis of their advisory role. So it is a kind of defense measure for the managers of the transaction. So they will double check the information which is included in the draft offering document. Might it be a prospectus or offering circular? Will answer questions to the managing board of the issuer to double check whether all the information is accurate, in order not to be found guilty of giving misrepresentations to the investors. Which topics are typically covered in a due diligence question? That can be quite extensive document. Usually we have around 100 questions which are answered by the managing board. There will be questions on the outlook and strategy of the issuer, questions on the ownership, on the share capital of the issuer, subsidiaries, so the entire company structure, the financial performance. Then there might be industry specific questions. So in case of banks, it might be the non-performing loan portfolio, etc. Furthermore, questions on the management of the issuer will be asked on regulation, litigation, any material agreements or any agreements which have been conducted outside of the usual business of the issuer, questions on accounting. So there could be questions arising like have there been any discussions with the auditor? Did the auditor post any material questions in the order of the last auditing? It will be questions on ratings and other important developments. What else will we have in a DCM transaction? There will usually be a roadshow. What means a roadshow? That's usually a couple of events in certain cities where big investors are located, where the investment banks would go together with usually the CFO of the issuer and speak with investors, maybe have one-to-ones with large investors to stimulate the investor appetite. After the roadshow, there will be a book building, which is the mechanism where the investment banks see how the market appetite is in order to find out the right pricing for the bond. So they will see how much interest does the issuer need to pay to the investors in order to get the entire volume placed in the market. Then there will be the pricing and signings. On the basis of the results of the book building, the investment banks will recommend a price to the issuer. This price will then be set, and then documentation will be signed. And after the signing, usually between 3 and 5 days, there will be the closing of the transaction, where certain conditions, of course, apply. So usually you will need a comfort letter of the auditor, which is a document where the auditor confirms that it has audited the annual financial statements and that all the figures which are included in the offering material are correct. So they will need to check all the figures. Then you will have the signing, of course, of the contractual documents. You might have a legal opinion, and you usually have a closing certificate, which is a document where the managing board of the issuer confirms that there has been no material adverse change happened. So once all this is done, then the settlement applies, which means that the securities will be booked on the securities accounts of the investors, and the issuer will receive the issue proceeds. Now we'll go into a bit more detail on the documentation. Why is there written standalone transactions? We will later also speak about issuance programs. This is now just how the documentation look if you do for one single issue of bonds, one prospectus, and so not a base prospectus. Which documents do we typically see? There will be a mandate letter. So that is the document by which the issuer mandates his banking syndicate, which is in charge of the transaction. Then there might be an invitation fax. That's the older document, or just a term sheet where the lead managers would invite other banks to participate in the syndicate. There will be some kind of disclosure material, which in case of a non-exempt public offer would be a prospectus. Otherwise, it could be called information memorandum. There will be a subscription agreement, which is sets forth the rules under which the banking syndicate would agree to subscribe the notes. Then there will be an agreement among managers, so that's the contract which establishes the legal relationship between the banks in the banking syndicate. And usually, in case of banks, the issuer may take the role as a paying agent himself, or it could be that it's another bank in the function of the paying agent. For the closing of the transaction, you will need a further set of documents. So usually in bigger transactions, you have a signing and closing memorandum, which sets forth step by step who needs to do what in order to close the transaction. Then there will be the global notes, which might be temporary and permanent. Global note in case of TEFRA D. There might be legal opinions, comfort letters. Whether these are needed depends very much also on the type of transactions. What we more and more see, for example, in case of covered bonds, that the lead managers say they don't require a comfort letter for the covered bond because you have anyway the cover assets, so you don't need this extra comfort. And they will of course issue a board resolutions or minutes of the boards be required and maybe further documents. What do we have usually included in the mandate letter? There will be already the key information about the transaction. So you will have already in what kind of instrument should be issued, like what is the status of the bond, what is the tenor of the bond, how does the coupon look, is it fixed or floating? There will be the duties of the investment banks, so what the investment banks agree which services they should perform for their consideration. So whether they will organize roadshows in which countries, might this be just local, or should there also be roadshows organized in London or Zurich or Amsterdam or elsewhere? Then the severability of the obligations. Usually you might have in a bigger transaction a split of roles between the investment banks. We will hear later about that, so that one bank is, for example, in charge of the documentation, that would then be the doc lead, or another bank might be in charge of the roadshow materials. So that might also all be in the mandate letter, also which information, how information might be used, then of course indemnification and preconditions to participating in the transaction. Why is the mandate letter so important? We see usually when an issuer invites banks to negotiate the potential engagement in a notes issue, then of course all the investment banks will make big promises in order to get the mandate. And at the end of the day, sometimes we see that not everything can be provided that easily, and especially what you have in the mandate letter usually is very hard to negotiate out. So if you as an issuer want banks to provide certain services, that should be written in the mandate letter, because otherwise at the end of the day it might be that your bank syndicate tells you it was agreed that we receive this amount of consideration for service A, B, C, D. If you want also to have service E, then you will have to pay more. The prospectus or offering circular is the legal and regulatory disclosure document. What's the difference between the prospectus and the offering circular? In case you have a non-exempt public offer as defined in the European Union prospectus regulation, you need to establish a prospectus and have it filed with the competent authority, and the content of the prospectus is in detail set forth in a delegated regulation. In case you don't fall in the scope of the prospectus regulation, which might be because you do a Euro 100,000 denomination, minimum denomination of notes, then you will also produce a kind of offering circular. Might it be for the listing venue, might it be just for general information of the investors, but in that case it's like up to the issuer what content will be provided there, and it more or less follows just a certain market standard, but there is no fixed content, and in particular the document does not need to be approved by the regulator. It might need to be approved by the stock exchange, but there's no inclusion of any financial markets regulator, which makes it of course quicker and cheaper. Move to the next slides. In the subscription agreement, as indicated, it sets forth the conditions under which the underwriters are prepared to subscribe the issue. The key obligations are, of course, the issuer agrees that it will issue the bonds, and the manager agrees to subscribe the bonds. And what main clauses will you have inside? You have, of course, reps and warranties. You have usually a force majeure clause, so that gives the underwriters the possibility to step back from the transaction in case of any material change which hinders them to place the securities in the market. You will have covenants, you will have indemnities to the manager. Now let's go into detail on the reps and warranties. Those are generally statements of facts. It will be the contractual basis on which the transaction is entered into and serves information, risk allocation, relation to closing conditions, and relation to termination. There will be legal warranties, of course, as in other contracts, on the legal status of the issuer, on powers and authorizations of the issuer, validity, ranking, selling restrictions, commercial warranties. So this is something what you find also in other contracts in finance. The agreement among a manager is, as outlined, the agreement which sets forth the legal basis for the cooperation of the syndicate banks. There are usually ICMA standards, so from the International Capital Markets Association, and usually it is just referred to like which kind of this standard template the managers will take. That is then also regulated, like in which proportion the fees are shared between the managers. In case the issuer is not performing the role of the paying agent himself, if there is a separate paying agent, then there will be a paying agency agreement which sets forth the legal basis for the other bank acting as a paying agent, so as the bank which is responsible for transferring the funds in case of coupon payments or payment of the redemption amount from the issuer to the investors. In case there is an English law governed issue, there might be also a trust deed required, where the trustee would act in favor of the bondholders. As outlined before, there will be the global notes which represent the entire issue, which might be either just one global note, or you have a temporary global note which would be exchanged after 40 days in case all investors confirm that there's no material US interest. Then it could be exchanged against a permanent global note. This is due to some US tax law reasons, and usually you will have legal opinions included, which give comfort to the managers as to the legal basis. As we know in other transactions, I think this is nothing new here. And the comfort letter gives comfort on the financial information which is disclosed to investors in the prospectus or other information memorandum. What is happening there? Some poor associate will spend a few nights in comparing each and any figure which is included in the disclosure document and compares this with the audited financial statement of the issuer, and then each figure in the disclosure document will be marked with a letter. For example, it might be A, that means that the data conforms to the audited financials, or a C and D letter means that the data is extracted from accounting records. And this will be done with each and any figure, which gives again the underwriting banks sort of comfort that the information document they use and share with the investors is accurate, and that there are no misrepresentations which could lead to a liability of the investment banks vis-a-vis the investors. Other documents we might need are board resolutions, power of attorneys. Why is that? Often, especially in a bigger banking syndicate, not each of the syndicate members will sign the subscription agreement, but they will usually to the doc lead. All the banks will give a power of attorney to the doc lead, and the doc lead would then sign the subscription agreement for all the other syndicate members. You might need listing particulars. I think Matthias can tell us more about that later on, and there might be a process agent later. And what is usually very sense-making and making things easier is that we have a signing and closing memorandum, which is just a short guideline saying which party has to provide what at which time in order to safeguard timely closing of the transaction. That was now certain information on standalone issues. Now we want to touch base with debt issuance programs. What is a debt issuance program, and why do we do that? Frequent issuers like banks like you, which do not issue like once a year, but which might issue a few times per year bonds. For them, it is often a burden to have a prospectus established for each transaction. Why is that? As we said before, the prospectus involves the regulator, and the regulator is a party you can hardly chase. So as long as they need, and this could then bring our timetable into trouble in case the regulator is not working like we want. What can we do in that case? We do a base prospectus. This would be a prospectus approved beforehand, which sets forth the general basis for issuances. And then for the actual issue, you do not need to have another document approved, but you just prepare a set of final terms, the sample of which are included in the base prospectus. You just fill in, like what is the tenor of the issue, what is the size of the issue, and some other information. And by that, you can be quite quick in issuing. We're speaking about normally for getting a prospectus approved. I think it can hardly be done under 2 months. Preparing final terms can be done in a few hours. So there you see the obvious advantage, and this is also the reason why most of the banks we are taking care of have issuance programs. They are usually called EMTN programs, or medium-term note program, or DIP, which is short for debt issuance program. And this offers them the possibility to be very quick, because as we know in capital markets, sometimes there might be an interested window of opportunity, and if you miss it, and then there comes, I don't know, a meeting of the European Central Bank where something is announced, this could change the interest environment rapidly, and if you then have to wait for the regulator, you won't be very happy. So what's the key difference to standalone issues? We speak not of a prospectus, but you have a base prospectus and the final terms then for the actual issue. Same like with the base prospectus, which lays down the basis of new issuances. You also have, instead of the subscription agreement, you will have a program agreement. It might also be called a dealer agreement. And this program agreement sets general forth the requirements and the conditions under which the dealers, so the banks which are on the program and parties to the program agreement, they would be called dealers, like which reps and warranties they want to see. And you would usually have already as an attachment to the program agreement, you will have a draft subscription agreement, which is pre-agreed, and also, like in case of the final terms, can be filled in quite quickly. And the good thing is you do not need to negotiate it, because it has been negotiated already beforehand when the program agreement was entered into. You might also have a procedures memorandum that is the same like a signing and closing agenda, just for the program. So that would say, I don't know, in case of euro-denominated issues, you have to make these and that steps. In case of British pound-denominated notes, these and those steps required. You also have the legal opinion already at the program establishment. Again, that makes it quicker, because then for the actual drawdown, you do not need to negotiate your legal opinion, but you just make a drawdown legal opinion where you in fact say we confirm that all the statements we were giving at the program establishment are still true. So, and the same you have with the comfort letter. So it is just the idea of that issuance program is that you make as much as you can already beforehand and pre-agree, have the prospectus already approved from the regulator, have all the documents already agreed with all the involved parties, and then when you find the window of opportunity, you are very quick in setting up the documentation for a deal. This can usually be done within a few days. You can document an issue. That was now shortly on the debt issuance programs. Now we look on the division of the roles involved in DCM transactions. You see in this short chart, you see you have the issuer issues the bonds to the managers underwrite the bonds and will place the bonds with the investors, and the proceeds go just the other way around. They would go from the investors to the managers to the issuer, and what happens then later on in the life of the bond, the interest and principal payment will walk from the issuer to the paying agent and the paying agent to the investors. Nevena, I think you wanted to say a few words on the main role.
Yeah, I mean, I was more splitting here about the main roles of the councils, but yeah, I can jump in with this as well. So the main roles of the parties generally are divided between the investment banks, where we do have a lead manager and book runner. In the large transaction, we can see 2 or 3 book runners or 2 or more joint lead managers. Sometimes we also have a co-lead managers and who have then a rather limited role in the transaction. This depends. So the bigger transaction it is basically there are more banks, more investment banks involved.
Maybe just to shortly jump in here, these different names of the banks that usually comes along with how high the commitment is. So they would maybe agree in the agreement among managers and say, if you take a ticket of at least 50 million, then you could have a joint lead manager function. If you take at least 20 million, you could be a co-lead manager. If you take at least 5 million, you could be a manager. So you might have joint lead managers, co-lead managers, and just managers, depending on the size of the commitment of the banks.
Yes, and one is what is important is that we have a pre-transaction phase and transaction phase. The pre-transaction phase is basically the initial structuring of the transaction. This is discussed between the investment banks and the issuers. And also in this phase, the banks are normally together with investment banks, and the issuers are together appointing the lawyers, the rating agencies, the listing agencies, partners. It's decided what the governing law will be, which then depends how the structure will continue in this regard. And then we have the transaction phase when everything is already structured. In this phase, our role is quite significant, because this is the documentation phase where we have drafting the documentation, and we have the final structuring activities. Because normally, in the meantime, when the transaction kicks off, we see what should be changed or what can be aligned in this phase, and this can only be agreed in the phase when we already know when the transaction already is kicking off. And then we have a selling and marketing activities that is done by the investment banks, and rating agency activities in case that we are having the rating of the bonds, which we normally do have. Yes, so this is just what we already now discussed. What are the main role of the parties? Just in the table. In the pre-transactional phase for the issuer, is important to decide what will be the governing law, to consider is there any obstacles for the issuance, make sure that all the internal approvals are in place, and consider whether there will be, to establish the virtual data room, and to consider where the bonds will be offered. Also in the transactional phase, the issuer is negotiating terms and the condition. It's working on the disclosure documents together with the councils, discussions with the listing authority, obtaining the rating from the rating agency, roadshow preparation, and in the post-transaction phase, ongoing obligations due to listing have to be fulfilled by the issuer. Now is this division of the roles between the councils. This is where we kick in and our job. So basically we have a arranger council. This is the council of the investment banks. And we have the issuer council. Arranger council is generally holds the pen on drafting the contractual documentation. This is the documentation Alex already mentioned. So subscription agreement, agency agreement, dealer agreement, depending whether it's a standalone issue or we have a program. Also, they are in charge to prepare the front and back of the prospectus and boilerplate risk factors and general risk factors relating to the notes. And they hold the pen on the terms and conditions and review the parts that are provided by the issuer council. Issuer council is generally in charge to provide the description of the issuer, so issuer disclosure part, where it's explained the general business of the issuer and certain other disclosures of the issuer, and also issuer council is providing risk factors which are linked to the risks of the issuer itself. Also, the issuer council review the terms and conditions and provide the comments and help the issuer with the corporate authorizations that have to be in place in order to have the issuance. As Alex already mentioned, for the approval of the prospectus, the whole process takes from 8 to 12 weeks. Depending, it can be longer or shorter, but let's say in average takes 12 weeks. What is important just to understand the structure of the transactions that we normally do have when we have, for example, issuance in Bulgaria, and we have arrangers and the lead council or the governing law abroad. We do have a international council who is structuring the transaction, and the local council of both arranger and the issuer. But normally these days we mostly see that we have a local council, which is the issuer council then, and we do have arranger council, which is then the international council. So this is all of our roles, and I think that Alex will take over on the type of investors.
Yeah, thanks, Nevena. So now let's look at the types of investors. Why do we dedicate a few slides on that? It's very easy. The entire structure usually depends on the investor base. So if you think of what kind of structure, how do I want to structure my bond, you first have to think what's your investor base. Do you want to approach retail clients? Do you want to approach big insurance companies, asset managers? And first you need to be clear in who will buy my bonds, because then you can think, what do these investors require? For example, if you want to approach insurance companies, it might be worth speaking with them beforehand, because the internal guidelines of many insurance companies say that they may invest in large scale only in bonds which are listed on a regulated market. So if you forget that and say, okay, I better choose the MTF because it's cheaper, because I don't need a prospectus, and then you go there and approach the insurance companies, might be that they say, sorry, wrong market segment for me. Also, certain institutional investors might have policies which restrict them to invest in debt governed by certain law. For example, we know that there are certain large-scale investors which say they do not want to have, I don't know, might it be Bulgarian or Hungarian law governed bond because they don't know the legal system, they don't understand how this works. They only invest in securities which are governed by English, German, or Austrian law. That might be. So that depends on the investors. Also, if you want to approach the retail segment, so small consumers, then you need to take care, especially because there might be consumer protection laws which kick in, at least in Austria. Nevertheless, the bonds would maybe be governed by English law. It might be that certain Austrian consumer protection laws will apply. So that might lead in increased expenses for legal advice because you might need more local law advice. Also, what you should take care of, what is the language for the documentation? Usually in large transactions with international investment banks, English documentation will of course be fine, but in case you want to approach retail clients, it might be required to have a local language involved, because otherwise the retail clients might go to court and say, I couldn't understand the English language prospectus, and so not all the required information has been disclosed to me in a manner that I can understand it. Also, there might be special legislation kicking in. For example, in case US investors are approached, there is this Employee Retirement Income Security Act, which sets forth special requirements for these like pension funds, and that's just some special things you should take care of. Also, depending on the markets which are approached, local selling restrictions must be complied. So if you want to approach the UK market, you might need to insert a few coins at some UK council to give you a UK selling restriction. So as we now saw, that it really depends on the types of investors you want to approach for the whole structure of the issue. We now look into a few practical aspects of debt issuances. Here we see a typical timeline in a very easy one. So we start with the mandate. So when the investment banks are mandated by the issuer, and usually then immediately the preparation of the prospectus and roadshow materials is started. So the issuer with the Issuers Council will work on the issuer description of the prospectus, whereas the arranger and the arranger council work on the securities description and on the structure of the securities. Then well ahead of the prospectus approval, there will be the due diligence call. Why well ahead? It might be that within the due diligence call, you find out that something is not correct in the prospectus. And then you should have still the chance to have another filing with the regulator and change that in order to get the prospectus in line with the statements of the management in the due diligence call. Then at a later point in time, there will be a pre-sounding. What means pre-sounding? That means that the banking syndicate will approach certain high-profile investors and get some flavor how the market will take the issue. So get some indication of pricings, to have a better idea and to tighten them more and more. We go to the execution. They will more and more tighten in what is their price indication. Then at one point in time, there will be the prospectus approval. That's usually before the start of the roadshow, because at the roadshow, it might be that already retail investors might be, or it cannot be excluded that retail investors might be approached and taking part in the roadshow, and then you should not trigger a public offer without having the prospectus approved, because this could result in severe fines. So then you will have the roadshow where the investment banks, together usually with the CFO, go to a few venues, might be, for example, Vienna, Zurich, Amsterdam, London, and present the issue and are there for questions of the investors. And once this is done, the book building phase will start. So then the investment banks will invite investors to place orders in their book. And once this exercise is done, the investment banks will know which coupon the issuer needs to pay in order to get the whole deal placed in the market. Then the pricing will take place. So the investment banks will give a recommendation to the issuer where the issuer should put the coupon and the issue price. And once this is done, then usually the public offer period where also retail investors can subscribe bonds will start at the pricing, after the pricing and signing. And this is then open usually a few days only. And once this is done, the closing will take place and the issuer will receive the issue proceeds on his account, whereas the investors will receive the securities on the securities account. On a step-by-step approach, as indicated before, it is very important for an issuer to make his mind about what he wants from the investment banks already when he sends out the RFP, the request for proposal, because what is in there, for that you will get a pricing from the investment banks. They will tell you, dear issuer, you need these few things from me, and for that consideration, I will provide that. You will have in the RFP, you should have considerations on the market environment, considerations already on the structure and pricing, and a presentation of the project team on the issuer side. What also needs to be taken care right at the beginning is the maturity schedule. So when so to have a look at which point in time the issuer has a refinancing need. So is there an older bond to be repaid soon, in order to find out when at the latest the funds are needed from the issuer, and also together with the investment banks, it should be thought already on a pricing indication. So usually what would they do? The investment banks, they would find, for example, some peers from the issuer. So if the issuer is now, let's say, a Bulgarian bank, they will look for some other banks in the region which are of a comparable size, and would, for example, look at which price their bonds are trading at the exchange. And then based on this, with some plus and minus, you come to a price. Like for some longer tenor, you will add a few basis points. Then in case, for example, that the rating is better or worse, there will be added or subtracted a few basis points. Usually, if the issuer is first time in the market, a so-called new issue premium needs to be offered to investors. And also in case the issuer is taking less than 500 million, then we are on the sub-benchmark size. That will also cost a few basis points, because the investors will then tell you if it's lower than 500 million, then it's not so interesting for us, because it might be not very liquid in trading. The investment banks will usually suggest a syndicate with a few book runners. Why is that? All the investment banks have different contacts, different markets. So it might be that you have, for example, if you are a Bulgarian bank, you might have maybe RBI or Erste or another bank which is in the local market. It might well be, if you intend to approach also investors in the UK, that you will take some UK bank on board. Or if you want to approach investors in Scandinavia, it might make sense to take a Scandinavian bank on board, which has there the required contacts. Usually, it also makes sense to have a bigger banking syndicate, because then also the investment banks can divide the responsibilities, which is a big relief also for us lawyers. If you, for example, say you have one doc lead, like one of the 5 banks is responsible for the documentation, and then you would ask them that the doc lead only comments on your documents. And so the bank has then to consolidate all the comments from the other syndicate members, which is a big relief for us lawyers, because otherwise you would receive for each document 5 sets of comments from each of the banks. You will have one bank which is responsible for the roadshow presentation, one bank which is responsible for Mender Letter and working party list, investor profiles. You see down all the different roles. So they will also support in rating in the negotiations with the rating agency and so on. Also, the issuer will need to consider, of course, with the help of the investment banks, whether the notes issue should be listed and on which market and on which market segment the notes should be listed, whether a rating should be obtained, which currency should there be, etc. Moreover, also a range of legal policy and financial objectives need to be taken into consideration in the process of the bond offering. So the issuer needs to bear in mind, inter alia, the following questions. Are there any legal or statutory constraints applicable in the bond structuring phase or the bond issue itself? Does the issuer need to adhere to certain financial or policy objectives? Is there a structuring criteria imposed by the rating agencies? So it might be that the rating agency say, I need to see this and this or that structure in your notes, otherwise your rating might drop a notch down. Also, you need to take care of the size, which is sought, as indicated before. Certain investors, for example, you will not easy get into sub-benchmark size issues, or if you get them in, you will need to pay a considerable premium for the sub-benchmark size. So it might then make sense to say, let's wait onto the notes issue now, but for example, next year, another bond is maturing and I have there a refinancing need of 300 million just for the bond and 200 more million I need for some other projects. So then I have 500 and we can do a benchmark size issue. Also, the budget limitations have to be taken into account. Now look further to a few specific questions at the end. If we look at the governing law, when you think of should this be, should we do it under local law? Should we use English law, German, or even Austrian law? As outlined already before, that depends always on the investor's requirements. If you have a small size issue, for example, if you want to do maybe only 10 million, you might do it under local law. If you find enough Bulgarian investors, which are happy, of course, usually with Bulgarian law, then you can do it under Bulgarian law. I doubt that you will find investors for 500 million if you do it under Bulgarian law, because maybe many big investment companies and insurance companies would say, I'm not so happy with Bulgarian law because I don't understand Bulgarian law. I would need more money for paying Bulgarian law counsels to explain me the legal concepts there. So these are all things to be taken into consideration. And also what we saw, usually often in the big transactions, you had English law. This is recently changing more to German and Austrian law, particularly for banks, because under this CRR you have the requirement to get a separate legal opinion on the enforceability of UK law contracts, which makes it then more expensive to get a legal opinion from a UK lawyer. So we saw, for example, with companies from the Erste Group, there are certain subsidiaries are now issuing under Austrian law. Also, the currency you need to take care of. First, depending on the investor requirements, because all the big investors, they have pockets for different currencies, and then some that don't like to invest. And of course, in case you invest in a currency other than your home currency, you need to take care of hedging costs. Also, the denomination is something you should take care of an issue, because in case you say you're fine with only big institutional investors and high net worth individual, it might be worth thinking of a euro 100,000 minimum denomination, because then you usually don't need a prospectus in case the securities are not listed on a regulated market. So then many investors do, for example, to try a bond, make a small issue in a euro 100K denomination listing on an MTF that goes quite straightforward, quick, without high documentation costs. So, and now I'm at the end of my presentation and like to hand over to Irina.
Hello, everyone. Thank you, Alex. My name is Irina Dekova. I'm a consultant at the Banking and Finance Department of Theiss, Bulgaria, and I will be speaking today about the Bulgarian aspects of bonds issuance. So let's begin. All right, Katerina already gave an overview of the Bulgarian legislation. The main legal act in Bulgaria which regulates bonds is the Bulgarian Commerce Act. Of course, there are also special statutes which also regulate bonds, for example, the Public Offering of Securities Act. There is also legislation on European level, which was already mentioned by Alex, for example, the Prospectus Regulation. So let's begin with the main question. What is a bond? Well, there is no statutory definition of a bond. Instead, the most often given definition is the one which is set out on your screens. So let's read it. It's a security which materializes in case of a materialized bond, or expresses in case of a dematerialized bond, a receivable of the bondholder for a specified monetary amount, which amount is initially received by the issuer in exchange for the issuance of the bond. So let's take a look at some of the elements of this definition. First, a security. Indeed, the Bulgarian Commerce Act expressly stipulates that the bond is a type of security which may be issued only by joint stock companies. Then, it's a receivable. The receivable will be equal to the nominal amount of the bond, and it will be in the same currency as the bond. Indeed, bonds may have different nominal amounts, even if they are from the same bond issue. Next, the bond materializes or expresses a receivable. So when a bond materializes a receivable, this is when we're talking about materialized bonds. Katerina already explained that there are two types of bonds according to Theiss classification, so materialized and dematerialized bonds. Materialized bonds are private paper documents, and just like any other paper documents may be transferred or encumbered, just like paper documents. Until recently, in Bulgaria, there were two types of materialized bonds. First type was a bearer bond, and the second one was a registered bond. However, changes were introduced to the Bulgarian Commerce Act in 2018, which abolished shares in bearer form. And because the same rules as those for shares apply to bonds, it's now considered that it's no longer possible to issue bonds in bearer form in Bulgaria. This means that we can only issue registered materialized bonds. And these bonds require a special legal act to be transferred. This act is called an endorsement, or GIRO in Bulgarian. When a bond expresses a receivable, this is when we're talking about dematerialized bonds. These are bonds which are registered in a central depository. And the central depository is the institution which administers the bonds and keeps the bondholder's book of the issuer. Indeed, dematerialized bonds are the norm for publicly offered bonds and for bonds listed on a regulated market. They may only be dematerialized. Let's move on. So now that we know what a bond is, we're going to take a look at the two main sets of rules in Bulgaria. The first set of rules is with respect to non-listed and non-publicly offered bonds, and these are the rules set out in the Bulgarian Commerce Act. The issuer of such bonds may only be a joint stock company. This is in contrast to some other countries where other companies may also issue bonds, but here in Bulgaria, we're a bit more limited in that sense, so that only joint stock companies may issue bonds, although both public and private joint stock companies may do so. And what is required in terms of formalities? Alex already mentioned that very often a board resolution will be required. Well, in Bulgaria, that would not be sufficient. Here in Bulgaria, we need something else, which is the resolution of the general meeting of the shareholders. There are no requirements actually under the law for the quorum and majority of such a resolution, which means that the usual requirements apply. These are that there is no requirement for a quorum and just a simple majority of the represented shares will be enough so that a resolution will be adopted. Well, the resolution itself needs to give the main details about the bonds and also the main details about the issue itself, and could also provide that certain rules from the Public Offering of Securities Act will apply with respect to a bond trustee or the security if the bonds to be issued will be secured. Alternatively, the statutes of the company, these are of the bank as an issuer, these are the articles of association of the issuer, may give powers to the managing body to issue bonds. Usually, in that case, there will be a certain maximum amount of bonds that may be issued by the managing body, and up to a certain number of years or a certain specified period of time, which may not exceed 5 years. Of course, there is no problem after the expiry of these 5 years for further authorization to be given so that the managing body may be able to issue bonds for further 5 years, if so is decided by the shareholders. Now, in two cases, this resolution will not be sufficient and will need another resolution as well. The first case is in case of issuance of preference bonds, which gives some sort of repayment preference. In this case, if there are bondholders of previous unpaid issuances, they will also need to approve this new issuance because obviously their rights will be affected by this new issuance, as those new bondholders will have a preference and will be repaid in advance of the previous bondholders. The second case is in case of an issuance of convertible bonds. These are bonds, as Katerina already explained, which may, under certain circumstances, be converted into shares. And obviously, if there are existing convertible bond issuances, those bondholders will have to approve this new issuance because their interests are affected. They will be diluted, so they have to say yes. Now that we've discussed the formalities, let's take a look at the actual steps involved in the process. The first step under Bulgarian law is a subscription offer. This is intended to somehow replace the offering memorandum or the prospectus. It's a document prepared by the issuer, although it's a very, very much simpler document. It is called an offer under Bulgarian law. However, it's not an offer in the normal contract law sense of the word. You know, a contract is formed by an offer and an acceptance. It's not such an offer because once the investors receive that offer, they may not by a simple yes enter into a contract because that offer does not contain the main essentials of a contract. The offer does not, for example, specify the exact number of bonds that each investor will acquire. It does not allocate the bonds between the different investors. So what is it then? Well, it is a type of a marketing document. It gives information to the investors, main information, which would enable them to take the decision whether or not to invest in bonds. When I say marketing document, I want to be clear that it should not be marketed to the public because that would convert the bonds from non-publicly offered to publicly offered and will trigger a lot of additional requirements, which were already discussed by Alex. For example, there may be a need for a prospectus, etc. The rule of thumb is that it should not be offered to more than 150 recipients, although, of course, there are exceptions to this rule, but that's just the norm. In terms of formalities for the offer, it needs to be in writing, signed by the issuer, and its contents are set out in law. So the resolution, which I already mentioned for bond issuance, needs to be described in the offer. Then certain details about the share issue, the bond issue itself. So, for example, details about the issuance and bonds, total nominal and issue value numbers, type, nominal and issue value of the bonds, and transfer restrictions. Details about, of course, the interest or income from the bonds. Details about the method and time for payment. Details about any collateral in case of secured bonds. And details about the subscription process itself. So where, when, how, under what conditions the bonds may be subscribed for. And also any minimum and maximum amount of subscription. And then, as I already mentioned, it should not be a public offer. Now let's continue. Right, the next step is obviously a subscription by the investors. This normally takes place on the basis of a subscription agreement, which was already discussed in detail by Alex. The subscription is itself just an act by which the investor undertakes the obligation to pay for the issue price of the bonds that it is subscribing for, and it can only be irrevocable and cannot be made under any conditions. It just specifies the number of bonds that each investor will buy, essentially. After the subscription, there comes the payment for the bonds. Here we've got two main differences with a share issue, for example. The first one is that the payment needs to be of the full issue price for the bonds. As you may know, in case of a share issue, not the whole full price needs to be paid in advance, just a part of the price may be paid, and then the rest of the price may be paid within a certain period of time, for example, not exceeding 2 years. The second difference is that payment may only be made in cash. Again, here we have a difference with a share issue, where it is possible for a non-monetary contribution to be made. The payment itself is made through a bank or an investment firm, which may act on behalf of the issuer or in its own name as an underwriter. And as Katerina already explained, that means that the bank or investment firm will acquire the whole bond issue and will then on-sell it to the market as an underwriter. And in that case, where the bank or investment firm acts in its own name, then it is normal for the bank account to which the issue price is paid to be opened under the name of that bank or investment firm rather than under the name of the issuer. Last, there is also a rule under law that money may not be used until the announcement of the bond issuance in the commercial register. And that rule is here to protect the investors so that they know that the money will not be spent before the subscription process as a whole is completed. Right, next, the issuer needs to enter into a contract with the bank, which will regulate payments under the bond. So that's going to be a paying agent or paying bank. And this contract needs to be entered into under Bulgarian law within 14 days after the end of the subscription period. Alex already mentioned that if the issuer is a bank itself, it is often to see the issuer itself being in the role of paying an agent. Then an announcement needs to be made in the commercial register. The announcement needs to be of the successful completion of the transaction. So value, issue date, maturity date, paying bank, details about the first bondholders meeting, stuff like that will need to be disclosed on the register. And the announcement needs to be made within 1 month after the end of the subscription period and is normally made by the managing body of the issuer. The last element of the whole process is the issuance of the bonds. Well, in case of materialized paper documents, that means preparation of the bonds and handing them over to each individual investor. And in case of dematerialized bonds, it just means that the bonds will have to be registered in the central depository. And this whole process is normally undertaken by the bank or investment firm, which holds the payments for the bonds. And lastly, there is this formality of registration in the bondholders book of the issuer in case of materialized bonds. That's just a perfection with respect to third parties. And in case of dematerialized bonds, this process of registration creates the bonds themselves. Actually, this may not be the end of the whole process because there might be requirements set out in the resolution by the shareholders, which may also have to be complied with. So it may be the case that the shareholders have decided that a minimum or a maximum amount of subscription needs to happen for the bonds to be issued. So if, for example, the minimum amount of bonds are not reached, so these are not issued, then the whole issue will fail and no bonds will be issued. And on the contrary, if the maximum amount is exceeded, which is set out in the resolution, then those investors who have paid for the bonds after that amount has been exceeded will not be able to subscribe for any bonds. Now, this was all about non-publicly offered and non-listed bonds. And now let's quickly take a look at the other set of regulations, which are with respect to publicly offered and listed bonds. Here we've got a bit more rules because of the broader investor base and the fact that investors may need more protection from the law. The issuer, again, may be a joint stock company, but as I mentioned, it could be a public or a private company. So it doesn't matter that a company is private, it may still offer bonds to the public. The public offering may be by way of subscription, as I explained earlier, or it could be an IPO by a dealer, which will acquire the bonds and then on-sell them to the market. Such bonds may only be non-materialized, as I mentioned before, and they should contain no restrictions on transfer, especially with respect to listing. As Alex already explained, the core thing here is whether there is a requirement for a prospectus or not. If the offer is non-exempt, then a prospectus will be required, even and it's going to be a lengthy document, and the whole prospectus regulation and the issues that come with it will apply. In Bulgaria, this prospectus will have to be approved by the Financial Supervision Commission, which is the competent authority in Bulgaria. If the bonds to be issued will be secured, then there is a requirement for a bond trustee to be appointed. The bond trustee is an entity which acts in the interests of the bondholders and normally holds the security under its name. The fees for the bond trustee are paid by the issuer, and usually the contract with the bond trustee forms part of the prospectus, and the role is normally taken only by banks or investment firms, and they actually have to comply with specific requirements to act as a bond trustee. Then with respect to such bonds, there are significant reporting requirements, mainly with respect to financials. So annual, semi-annual, quarterly financials will have to be reported, as well as there should be reports about any changes to the statutes or to the managing body and supervisory body of the issuer, or just any other major corporate actions will have to be reported. Then lastly, with respect to listed bonds, there might be requirements of the specific stock exchange on which the bonds will have to be listed. And so those requirements will have to be complied with as well. So for example, the Bulgarian Stock Exchange has not a lot, just some requirements. The main ones are that bonds may only be denominated in levs, US dollars, and euro. If you want to list on Bulgarian Stock Exchange, so that means you cannot list, for example, in GBP, in pounds. Then other requirements of the exchange include the fact that payments for interest need to be made on 1, 2, 3, 4, 6, or 12 occasions only annually. The interest, the period between the different interest payments will have to be the same, and there should be no restrictions to the payment of interest and principal. So these are the main requirements of the Bulgarian Stock Exchange if you decide to list bonds on that exchange. And this brings me to the end of the presentation. Thank you very much for the attention. And now I give the floor to Matthias.
Thank you, Irina, also from my side. And because I'm cautious about the time, as I think that we are running a little bit longer than anticipated, we will extend the duration of the webinar. So yeah, Matthias, take your time to walk us through your point of view as well. I also see that there are questions from the participants. So hopefully at the end, we will have time to answer them. If not, we may provide written responses while we are also listening to Matthias' presentation. And yeah, Matthias, now the floor is yours.
Thank you very much, Irina and Katerina. I'll anyway try to speed up my part and come to the very relevant aspects. First of all, it's my pleasure to be invited to speak at this virtual event. My name is Matthias Szabo, and I head the international debt listing business at the Vienna Stock Exchange. My main responsibilities include business development and relationship management. So in my role, I have been managing key relationships with investment banks, law firms, issuers, and advisors with the aim to support issuers seeking admission to listing of their fixed income securities in Vienna. I'm happy to share our knowledge about the features of a listed bond compared to other types of financing, the role of exchanges, and how Vienna Stock Exchange has positioned itself in the market. I'll start off by quickly running you through a couple of slides just to give you a quick introduction to Vienna Stock Exchange. We won't spend a lot of time here. Now, Vienna Stock Exchange is not really a new kid on the block, quite the opposite. We celebrate our 250th anniversary this year, which makes us one of the more established independent exchanges in Europe. We're owned by Austrian banks and publicly listed companies. Today, we offer a compelling service range of a fully regulated and modern listing and cash market infrastructure provider. Apart from the traditional stock exchange business, providing a reliable listing and trading platform for securities, we also develop new business fields that contribute to revenues such as IT services, index licensing, and also market data business, which is very important these days. Now, as you can see, we list several asset classes. I think like everything except derivatives. We used to have a derivatives exchange as well in Austria, but that ceased to exist. Now we have a lot of shares listed as well, not only Austrians, but also globally, from the US to Russian shares, even to Chinese equities. I think we added recently to our global market segment. And we have more than 16,000 tradable bonds, certificates, and warrants. So that makes us one of the emerging European marketplaces for international debt securities. Only a few years ago, our exchange mainly served as a well-governed and reliable listing and trading venue for Austrian corporations, financial institutions, and the Republic of Austria, of course. Today, more than 85% of new listings come from foreign issuers across Europe. This is because international capital market participants are looking for what we have been offering for quite a while: a simple listing process accompanied by exceptional competence and high service level. Now, with 3,200 new listings, we have already recorded more new bond listings this year than in the entire year 2020. The total volume listed was more than 90 billion euros from over 150 domestic and foreign issuers. And I always like to call Vienna Stock Exchange the home of professional market participants and institutional investors, because financial institutions are actually the leading issuer group in Vienna. We earned the trust of many financial institutions who are now the backbone of our business activity when it comes to listed debt securities. Most of the institutions listed on this page, or you can see on this page, have debt issuance programs or EMTN programs in place, as Alex mentioned prior in the webinar. Many of them supported, like many Austrians, of course, supported by Theiss. So there's a lot of competence there. However, from time to time, banks also tend to list standalone issuances with us, which is a very similar process, although programs are always a good way for frequent issuers to bring to Vienna. And we also cooperate with many of these institutions on multiple securitization transactions, and that quite successfully. On the corporate side, we were able to attract many well-known names in recent years, with issues from more than 30 countries, from the US to Italy and Spain to Russia. Vienna is a truly international and neutral marketplace. A great variety of products are listed on our exchange, and I would like to, just speak 2 minutes about ESG bonds, because we see an increasing demand there. So environmental, social, and governance issues are very important these days for companies and investors alike. In a green bond transaction, the use of proceeds are dedicated to finance sustainability matters, such as, for example, renewable energy projects, anything that helps, foster the climate change or support the climate change, or to prevent the climate change, actually. The social issues would be financing affordable housing. This is something where banks could step in. So we've seen several green bond and sustainability bond issues by Austrian banks who were refinancing loans they made to finance or refinance affordable housing or energy efficient housing. There is a wide variety of products out there, to be honest, and I would also recommend everyone to watch the ICMA sustainability and green bond principles. This is market practice right now. The validity of a green or social bond is usually certified by a sustainability rating or a second party opinion, which is created by a rating agency. It's not really what like the Moody's or S&P 500 or Fitch out there. There are other rating agencies really dedicated or experienced with sustainability ratings, and hopefully a bit cheaper than the global ones. We have a dedicated green and social bond segment and have seen a significant acceleration when it comes to green and sustainable finance activities, especially in the last 12 to 18 months. That has really picked up. Austrian issuers, including banks, have already raised more than 2 billion euros this year across 12 transactions. Again, this is a new high watermark, and there are a couple of transactions in pipeline as well. The newest variant are sustainability-linked notes, where an issuer would issue a bond, so raise money, and the coupon or the repayment of the bond depends on achieving or maintaining different KPIs related to, to a purposeful handling of climate or other social issues. For example, there was one issue in Austria where there were premiums on the redemption amount at maturity, which are granted for every year the ESG issuer ratings are below certain thresholds. This is kind of an easy entry into the sustainability bond market and allows issuers to, to target a rising investor group, a rising group of investors which are, shifting their investment guidance or principles towards a more sustainability focus. The role of exchanges is not, just helping educate investors and issues about green, social, and sustainable financing. It is also about providing the visibility and transparency the market needs to safeguard its integrity. I'm happy to elaborate on this in more details on a bilateral basis or in another webinar. I think that makes sense. Now, this was a brief overview of what we do at Vienna Stock Exchange. Now turning the page to what are the features of a listed bond compared to other types of financing. And this is a non-exhaustive list we have compiled based on feedback by market participants and based on many years of experience. So first of all, as I've learned from Katerina as well, there are investor requirements. Like if you want to speak to certain institutional investors, and this is not only true for Bulgaria, but across many different countries, if you're speaking to institutional investors like pension funds or insurance companies, they need to have that listing requirement fulfilled. Also in the portfolios of asset managers, a listed debt security is considered a liquid security, and it is much easier for them to invest into such a product if it's listed. Another important aspect is that a listing provides investor confidence. You have to imagine that an exchange reviews documents and approves for admittance to listing on their exchange. So this is kind of a seal of integrity or a stamp of approval, if you will, that raises the whole profile of the investor and the transaction. And it actually gives access to European debt capital markets and offers a wider distribution among a new, or a wider class of potential investors, and opens up the opportunity to tap capital markets every now and then. As soon as you have a listed debt security, you are kind of you're on the radar of banks and investors, and you can build your track record. And that ties in very well with the increased visibility you will receive for listed securities. Imagine if you decide to structure and issue a bond. This bond will have an international securities identification number, an ISIN code. If you enter that into any kind of system, this is and it pops up on Bloomberg, Reuters, and on exchanges. That is a huge asset for market participants, so that people know, okay, it's existing. That's great. Increased liquidity, I think that is a no-brainer, but also the last 2 points are kind of technical reasons to list a bond, and pretty much an incentive to issue listed bonds or raise funds by a listed bond. First of all, there are certain requirements to be met for bonds to be accepted as ECB collateral for the purpose of the Eurosystem. And both markets in Vienna, and I'll come to that in a second, are eligible markets for that purpose. So the listing checkbox would be ticked. And last but not least, as I've also learned from Katerina, withholding tax exemption, there's also a tax exemption in Bulgaria, as there is in the UK, Ireland, Spain, a lot of countries. This is a kind of a great monetary incentive for issues to list bonds. Now, when someone has decided to go the route of structuring a bond and issue that, one of the next question, somewhere along the process is, will it be a public offering or will it be a private placement? Do I need a regulated market, or can I list on an exchange regulated multilateral trading facility, in short, MTF? In Vienna, we have those two markets pretty much in line with other mainstream listing venues in Europe. The so-called official market is an EU regulated market. The Vienna MTF is where our exchange rules basically apply. Now, the regulated market is typically used for public offerings with an approved prospectus. So the EU prospectus regulation applies. There are two ways to approach that. First of all, you can go to the Austrian Financial Market Authority and have a prospectus approved there, or you can use the prospectus approval mechanism in the European Union, where you would go to the Bulgarian authority, competent authority, have a prospectus approved, passport it to Austria, and then the regulated market listing is basically almost an automatic process, so to say. In contrast to that, on the Vienna MTF, a prospectus is not required. So usually we are approached with a pre-existing offering circular, if that is existing. If no offering document exists, which might be the case in more, let's say bilateral deals, bespoke private placements, we ask for a short description of the issuer, which we call an information memorandum. This is nowhere near the scope of a fully fledged prospectus. On both markets, Vienna Stock Exchange is the competent authority for admission to listing. So with regards to listing, you would not deal with any other authority other than the exchange. And we do not see ourselves as an authority, but rather a service provider. Other differences are on the regulated list on the regulated market. The issuer applies together with an exchange member. That means that there is an application form where there is a signature by the issuer and an exchange member. We're always happy to put clients in touch with some of our exchange members who have a very standardized process of doing that. On the Vienna MTF, you don't need the exchange member. Any bank, investment firm, law firm like Theiss or the issuer himself can sign the application form. Of course, we recommend to appoint a bank or a law firm to handle the whole listing process, which makes it easier. Last but not least, there are some post-listing requirements. With the introduction of the EU Market Abuse Regulation 2016, the two markets became very similar with regards to ongoing obligations, especially when the denomination is 100,000 euros or higher, because then it's considered a wholesale issuance and you do not need to publish financial statements or semi-annual financial statements pursuant to the EU Transparency Directive. The EU Market Abuse Regulation is not something you have to be scared of, especially if you are a publicly listed company or a bank, because you have the governance in place. It's actually about maintaining a list of insiders. It's here to ad hoc disclosure and management transaction announcements, also related to the debt securities which are listed, but we hardly see any debt security like managers transactions in debt securities. Now, really briefly, the process. I always tell people that listing should be the least complicated task to achieve in any given debt transaction. So much work has been put into transaction prior to approaching the exchange. So how does it work? Actually, it starts by an informal touch base with the listing team of our exchange, discuss the transaction and the timeline. What is the intended issue date and listing date? So that puts us nicely on par with or on the same page with you. And actually, the second step is the initial submission of documents. That means submission of documents in electronic format, which is primarily the approved prospectus or base prospectus in case of a program. And if a prospectus is not existing, an information memorandum or offering circular, accompanied by a couple of corporate documents, which are existing anyway, to check the validity of the issuer and the issuance, like the board resolution, for example, that Irina was referring to, a commercial register excerpt, and the bylaws of the issuer, together with the last annual financial statement. So this is a pretty easy list to compile. We provide comments on these documents within a couple of days, very fast, very reasonable. And as soon as the documents are clear of comments, you may go ahead with a final submission, which means sending us the in electronic version, the duly signed and properly completed application form, which last but not least leads to the admission to listing and trading. We will issue an admission notice, the invoice covering all the fees, upfront, so you don't have to expect like an annual fee for the next 20 years because the bond has a tenor of 20 years. And we set up every bond that is admitted to listing and trading on our trading system, which is Xetra T7, developed by Deutsche Börse. We have a long-standing 20-year relationship with Deutsche Börse, and this is the trading system we run. And we also implement at other partner exchanges in the Eastern European region. The whole process, I expect that this may take a week or two. It depends on the quality of documents. It depends on how far advanced you are at the stage. But like from initial submission to admission to listing, like the second to the last step is 1 to 2 weeks, depending on if you list on the regulated market or the MTF. Because on the regulated market, we also have to pass the Austrian Stock Exchange Commissioner, which is usually not a real hassle, but he has like 2 or 3 days to review it as well, and we handle the whole process. When there is a debt issuance program, you just have to do it once in the beginning, and every new base prospectus, so every 12 months when a base prospectus is being updated, we have to renew the admission on the regulated market. On the MTF, this is only, the admission process only happens once in the beginning. Now, why list debt securities and why list them in Vienna? As both Alex and Irina mentioned, there are many requirements to think of in the structuring phase, which is based on various factors, such as investor needs, legal and tax considerations. So the exchange basically has to ensure that it can deal with a large range of different transaction structures and styles. The key message here is that if you were able to master every hurdle prior to the listing, you can expect that it's kind of a seamless process with the exchange. What does that mean? We can accept many different currencies, for example. So Bulgarian lev is, of course, accepted, as is euro, dollar, British pound, Chinese renminbi, you name it. We can deal with any governing law and legal form of the issuer. Also, local CSD, so the Bulgarian CSD would be accepted for listing purposes, as well as, of course, Euroclear, Clearstream. Again, the EU prospectus passporting is available, so it's your choice, which competent authority should approve a prospectus if need be. And we also have special segments for green and social bonds, and also a qualified investor segment. This is specifically designed for issuers targeting qualified investors, and admitted securities will not be accessible to retail investors, as trading is only permitted for or on behalf of qualified investors. That issuers who may choose to admit securities to trading on that segment enjoy benefits such as simplified MiFID II product governance or a simplified PRIPS disclosure requirement when it comes to complex products, as well as an alleviated prospectus disclosure regime for so-called wholesale issuances. And again, the green and social bond segment is there to recognize the nature of this new and emerging asset class. I'd also like to mention that every security that is admitted to listing and trading on our exchange is clearly and transparently displayed on our website, and I encourage you, if you're interested, to really visit our website, because I think it's one of the best exchange websites out there. You will find a lot of information, and all securities are displayed there as of their first trading day. Securities are searchable by ISIN code, title, or issuer name, with multiple filters available: segment, country, whatever. And based on availability, you will also find transaction documentation, notification to note holders, which were published, and prices and quotes. Why do I say based on availability? especially in the Vienna MTF, there is no requirement to publish the documents on our website or in any capacity. When the issuer authorizes us or actually asks us to upload transaction documentation on our website, we will do so, and you will find it on the website publicly available. Prices and quotes is always subject to if a secondary market is actually building. Please bear in mind that we can always only offer the infrastructure, but it's up to the demand to actually create a market on the exchange. We know that typically that securities are kind of an OTC traded security. So you will find many bonds that are not listed on the exchange. But again, like the infrastructure is there and it works. I think that's pretty important to mention. So that is it in a nutshell. I invite you to stay in touch with us. Follow us on Twitter. We have a great LinkedIn page to keep our partners up to date. The website I mentioned, we're on YouTube, and we do have newsletter services for our partners and people who are interested. Or contact us directly. My name is Matthias Szabo, and my colleague Satko Theiss covers Central Eastern European region, as well as Russia and the Middle East region, and we're both happy to answer any questions, maybe now or anytime you want to know more about how Vienna Stock Exchange works, and always happy to also engage into a conversation when it comes to a live transaction or the preparation of a live transactions. Again, we do not see ourselves as a strict authority, but rather a service provider that really likes to have a dynamic and interactive process with issuers and advisors. Thank you very much.
Thank you. Thank you
very much, Matthias, and I just can underpin what Matthias said. The Vienna Stock Exchange is a true service-focused service provider for issuers, and it's always makes great fun to work together with you and your team, Matthias. Thank you very much.
Thank you.
Thank you. Thank you, Matthias. Before we wrap up, probably just to look quickly at the questions at the chat box. Think that there was question about the green bonds and what in brief the green bonds mean. I think that Matthias, you've already covered this, so with view of the timing, think that this general presentation that you gave for the advantages of the green bonds is sufficient. The other question that I see is with regard to bond issuance for capital requirement purposes. Probably it's a question to the lawyers from the panel, whether we have seen such bond issuances for capital requirement purposes. And Alex, if you'd like to share just probably briefly your practice in this regard.
Yeah, thank you very much for this question. Indeed, we see many issuances for capital requirement purposes of banks. Might it be Tier 2 issuances or AT1 issues? What we just recently saw as a trend is that more and more local banks in CEE also use bond instruments for their MREL requirements, particularly at Raiffeisen and Erste Group, as these two banking groups chose the multiple point of entry resolution strategy, which goes along with the requirement of all the local subsidiaries to issue themselves. And yeah, and I think this trend will hold on.
Yeah, many thanks. There is also another question in the chat, which probably is more technical. Not sure whether you are able to respond to this now. Please advise whether audited comfort letters are in any case obligatory. In case we have published audited financial statements, annual financial reports, should we have a comfort letter?
Thank you very much for this question. As outlined before in my presentation, this depends largely on the type of instrument. So usually, if the bond is a senior unsecured bond or if it is a subordinated bond, the investment banks would require a comfort letter. However, if the bond is a covered bond or some ABS structure, then it might be possible to convince the investment banks to go without the comfort letter. Of course, this is subject to your negotiation skills, but we saw many transactions of covered bonds where the investment banks could be convinced to go without the comfort letter, which makes it, of course, much more cheap because as far as I am aware, some comfort letters cost up to 150,000 euros. So this is some money. If you can save that, you should.
Yeah, just to summarize the question, that it's not obligatory, it's just how the investment bank requests.
Exactly. There's no legal requirement at all. So no legal requirement. It just depends on which level of comfort the investment banks want to get.
Yeah, probably also depending on the grade of the issuer or other circumstances around transaction. Many thanks. I think that we have covered all the questions in the chat.
Sorry, I think there is one question left. The difference between bearer form and registered form.
Yeah, because it was please go ahead.
No, I think that also was mentioned by Irina in her presentation, that the difference is that bearer forms are in the materialized form and the registered are in the dematerialized form, registered with the central registries. So this is the main difference.
Correct.
Yes, and just from a Bulgarian law perspective, bearer form, which were previously in existence, these were documents which could, by way of a simple handing over, be transferred. These are no longer applicable in Bulgaria. So shares may only be materialized, registered, not share bonds, or dematerialized bonds. So we no longer have in Bulgaria bearer materialized bonds.
Yeah, while in Germany and Austria, this is quite common to have a bearer form rather than registered.
Yeah.
At least locally, following the changes in the legislation with review of disclosure of ultimate beneficial owner and IML requirements, one of the related changes was exactly this one, to repeal the regime for bearer type of shares and bonds. So probably we decided to be more advanced locally in that regard in terms of the local regulation. Yeah, I think that on that basis we managed to cover all questions. And before we wrap up and close today's session, I'll just quickly summarize the responses from the vote and from the poll questions that we asked at the beginning. So we asked two questions. The first was whether the participants are planning to act as issuers in bond transaction. And the second was whether they are planning to act as investors. The more positive votes are to the first question. So we see that currently, apparently the interest, at least of those that attended the seminar today, was for testing the market as in the role of issuers, which is a good signal that there is a type of investment activity in that regard. So I would like to thank you to everyone who joined us in today's session, and hopefully we'll be able to see you next time. It might be also able to do this in person, and we'll be happy to welcome you in our office as in the past. Thank you.